Hello, I'm Charlie Fuchs and you're watching this week's Weekly Wrap-Up. I'm on the line with Steve Ruffley, CEO at iViewCharts.com, to share his insights. Steve, welcome. The Canadian dollar was higher on Wednesday as it benefited from a major corporate deal that will see American fast food giant Burger King buy Canadian coffee and donut chain Tim Hortons for $12.5 billion. How do you foresee today's Canadian data releases as affecting the strength of the currency?
I think, conveniently we saw an indication of short-term strength coming into the CAD on Tuesday. And when the Burger King Tim Hortons deal was announced on Wednesday, we saw a sustained and brutal sell-off of the dollar CAD, really starting at the highs at 1.099, trading as low as 1.08143. So that really didn't indicate that some strength was coming to the CAD. I think we saw some light relief in the dollar CAD when the better than expected US GDP came out. That was expected 4% and it beat estimates at 4.2. So I guess now we're consolidating towards the bottom of the range and really looking for the technical trade is going to push the dollar CAD lower. I think Canadian GDP has probably helped again today. 0.2 expected, 0.3 was actual. So there's no real surprise the correlation between the Canadian data and US data. So I think if we're looking for a bit of a longer-term idea of what the CAD's going to do, I think technically we need to close below 1.08499 and really look at the monthly candles. And then we're going to see and really kind of target 1.03423 as a main pivot point. This really works around my understanding of Fibonacci and where the market's been from the lows of 2000 May 11 up to the highs of March 2014. So I think that's really a significant point of interest and where the market's going to really target.
Moving across the ocean, the Indian rupee weakened marginally yesterday ahead of key indicators, including economic growth data due today. Yesterday, the rupee retreated against the dollar for a third consecutive month. How do you see today's data releases as affecting the value of the currency?
Well, I think there's always a lot of speculation around emerging markets, and India, when we talk about that, is certainly a topic worth discussion. I think, unfortunately, the world's changed so much over the last decade that the lines between established markets and what's emerging market is really coming not just blurred but somewhat irrelevant. Investors are looking for safety, certainty, and really it's hard to quantify. I mean, if you look at economies like the US and the UK that really came to the verge of a collapse, who's to say where money is really safe? I would say that really what we're looking for, when we kind of talk about China, India, that the faster you grow, the harder the inevitable slowdown is going to hit. We've already seen signs of that in China. I think really for India, it's quite a difficult prospect. We've been such a huge country, and really the difference between the wealthy and the poor is so vast. We know that's quite unsustainable in history, not just in India's case. The GDP forecast is at 5.5, and I think that the fact that the rupee has gained around about 14% over recent months, and really that's all down to the kind of internal policies of controlling their deficit, and the fact that established investors are really fearing the top in the major indices. The reason why India and China are still seeing this growth is that we're seeing a flood of foreign investment still going to these emerging markets. I don't really think it's sustainable in the long term, but certainly in the short term, as investors look for some sort of safety, or I won't just say safety, more for just general diversification, that we're going to see some strength in these emerging markets. So I kind of see the rupee trading at a range of 610 to probably 680 in coming weeks. And I think for the rest of the year, although indices are remaining very, very high in the US, the UK, and generally the Eurozone, I can see a crash, so that is going to filter through and certainly affect economies like India and certainly the value of the rupee.
And finally, Spanish retail sales came out earlier this morning. Whilst the Spanish economy grew between March and June at its fastest quarterly rate since before the financial crisis, Spain's retail fashion chain Desigal's profits were up by 48% on the same period in 2013. Did the outcome of today's retail sales data release surprise you?
Well, I won't say I'm an expert in fashion, but I did live in Spain for a number of years, so I was quite aware of retailers like Zara and Mango. They had that kind of affordable style that made them very appealing to both men and women, so that's well known. I guess what's interesting is that the company we're talking about is really famous for this kind of bright signature dish, these clashing prints, and that really right now is hitting the market. Hitting the market at the right time with the right kind of people, and let's face it, importantly, people have got the money. So this is really the majority of profits are coming from their expansion, and it's the expansion into places like Asia and into Latin America. So massive markets in their own respect, and still relatively growing, so there is money. I don't think there's any surprise that the domestic demand from Spain is shrinking. We know the youth unemployment, is at record highs, so the people that are going to buy this fashion just simply don't have the money. I think it's absolutely no surprise at all. Also, when we talk about retail sales, they were expected 0.1, but the actual Spanish figures were minus 0.5. So that just really kind of correlates with the economic situation. And again, more that spending power of the youth. Although we've seen a little bit of recovery in Spain, I don't think anybody's fooled that the Eurozone in general is fixed, or especially Spain. I mean, we look at Greece, for instance. Greece have more debt than when the credit crunch started, because they've been allowed, to get that credibility back and back to borrowing. So the situation isn't really fixing itself, and I think the situation in Europe is still pretty dire. So any retailer, be them fashion, be them domestic white goods, etc., are going to see their sales hit. So it's all about looking for these emerging markets, very much as we spoke about India, but I would say Latin America and Asia are certainly huge for the fashion industry. So absolutely no surprise that even though a country like Spain is struggling, that you don't see these companies that see this rapid growth. And as you said, 48% up on this period, 2014. That's no fashion faux pas at all. That's something to be very proud of. So there's always winners, where there are losers. But I would say the long-term outlook for Spain, retail, and the Eurozone in general is still very difficult. We can see in the UK, the US, we're looking to raise rates. And in the Eurozone, we've got negative deposit rates. So it just goes to show that the situation in Europe, Spain, etc., is far from over. So I'm predicting a lot more bad news at the Eurozone before we see the inevitable upturn and some good news.
Well, that's all we've time for. Thank you, Steve, for all your insights. Have a lovely weekend, and remember to tune back in on Monday. Goodbye for now.